Internally, we've sometimes used this idea that our asset class in the past few years has been upgraded. I think historically the high yield asset class has been viewed as this speculative risk asset, but actually the asset class we see today is composed of businesses with much more resilient balance sheets, lower leverage, higher interest coverage. So perhaps if I quantify that a little bit, if we look back historically, sort of 10, 15, 20 years, a lot of that lower quality triple C part of the market was sort of about 20%, and as we sit here today, we're actually approaching 10%. And actually at the higher end of the market, that makes up approximately, if not north of 50%. So as we take a step back and we look at what investors are presented with today, we find an asset class that is higher in quality, much more resilient, and actually offering investors more stable, durable cash flows. And so we think as investors look to build a diversified fixed income portfolio, high yield is no longer that alternative speculative risk asset, but actually a staple or a cornerstone within fixed income portfolios. This is a question, of course, we address with a number of our investors. From our perspective at Principal, the one thing you need in an uncertain world when building an investment portfolio is some level of certainty. And as we sit here, a lot of the risks or concerns that people have traditionally had with the high yield asset class are perhaps no longer present, and it's occurring at a time where people are able to pick up still historically attractive yields. And so quality is higher, maturity walls have been pushed out, defaults are lower, and so the asset class is generating a very resilient, stable income for investors in a highly uncertain macro environment. We think that the high yield asset class is one of an asymmetric risk profile, and when we take a step back and we think about the way investors should construct portfolios, generally we think that that asymmetry requires investors to do three things. They should demand some sort of risk premium for holding these assets. They should monitor downside scenarios, and investors need to sort of more selectively allocate their capital rather than broadly, and when building portfolios, make sure that that capital allocation aligns with the areas of deepest fundamental conviction. So one of the ways in which we do that at Principal is by not using third-party rating agencies when we look at credit ratings within our portfolio. Our analysts assign and build their own credit ratings for each business that they follow, assessing cash flow sustainability, operating leverage, valuation, diversification of the business, etc. And often across our portfolio, we can find that our ratings will diverge from those third-party rating agencies by up to, call it, 65, 70%. Now, over time, we're able to capture alpha and therefore deliver quite significant risk-adjusted returns for our investors as those third-party agencies migrate their ratings towards ours. And perhaps lastly, given our view of that asymmetric risk profile, it also helps us to avoid those unexpected rating downgrades. We find that's because yield is a much greater reflection of the actual income generation of the asset class and also the reinvestment effects. So that's our first answer. The second part of my answer is probably multifaceted, but maybe two quick points. The first one is the technical of the asset class as we sit here today continues to be underestimated by investors entering the asset class and also those that currently operate within it. Within the asset class, this year we've seen quite significant year-over-year increases in gross supply, but on a net basis, when we account for sort of M&A and LBO activity, and particularly given the level of demand and inflows for investors into the asset class, supply into the asset class remains quite constrained, and so that keeps spreads fairly range-bound. I think the last point that we make to investors is, in a scenario whereby spreads were going to widen significantly, and by significantly we mean sufficiently so that it would offset the historically high income generation that the asset class is offering today, we'd have to sit here and ask, well, which event has caused this? And on such a day, how would other asset classes react, but also recover? And for us at Principal, on such a day, we'd much rather have our capital tied up in a higher quality, low default, income generating asset class.